Welcome back to the Deep Dive. Today, we are putting on our most skeptical glasses and going straight into the belly of the beast. Q4 2025 bank earnings. Citigroup, Bank of America, and Wells Fargo. The market, it's already cheered about earnings beats, but we know better.
We absolutely do.
We know that in the world of these massive financial institutions, the headline number is often the financial equivalent of a bait and switch.
It is. Our mission today is to just ignore all that fanfare. We're not here for the headline EPS number that gives the stock a little pop for an hour.
No.
We are here to assess the underlying, the structural health of these giants. We want to know, is the profit quality actually high? Or are they just relying on one-time gains?
Right.
Where are they actively hiding the risk on their balance sheet? And maybe most importantly, is management really building a predictable, robust business for the long term? Or are they just, playing accounting games to hit a quarterly target?
Exactly. And our sources for this are solely the bank's own materials.
The raw data.
The press releases, their financial supplements, the presentations. No external analyst spin needed. We are digging right in.
Right.
So let's unpack this, starting right where the most distortion happens.
Yeah.
Reported earnings per share versus the reality.
Yes.
Let's start with Citigroup, which has, I think, earned the dubious crown as the undisputed king of complex, heavily adjusted earnings reports.
The restatement king.
Yeah, exactly. They reported $1.19 diluted earnings per share for Q4. Now, for the average person, that's the number that hits the news wires. That's what triggers the initial reaction.
It is, and it's almost always a terrible indicator when you have a massive institution going through what is essentially a strategic dismemberment,
Right.
which is really what Citi is doing with all its global consumer exits. The key number for Citi, the one management really, really wants us to focus on, is the EPS excluding notable items.
And that number was?
It surged to $1.81.
Wow.
That is a gargantuan difference. It's a 52-cent spread, and it just fundamentally changes the narrative from, a weak result to actually the core performance was pretty strong.
Okay, that jump from $1.19 to $1.81 is huge.
Yeah.
Let's unpack this notable item. What exactly did Citi strip out, and where did they bury the pain?
There were two major items. First, for Q4, was a hefty $1.2 billion loss.
A billion, with a B.
With a B.
Wow.
It nets out to $1.1 billion after tax, and it was directly related to the loss on the sale of AO Citibank in Russia.
Okay.
Now, here's the crucial accounting insight. This loss was recorded in the line item called Other Revenues.
Other revenues. So that pulls down their whole top-line revenue figure. Why does that matter? Why not just book it as a standard operating expense?
Because if they booked that $1.2 billion as a regular operating expense, their efficiency ratio would look absolutely abysmal. It would crush their core operating metrics. By putting it in other revenues, they're essentially isolating that international exit. They're calling it a non-core event.
So they can pretend it didn't happen to the main business.
Precisely. It allows CEO Jane Fraser to talk about achieving positive operating leverage across the 5 core businesses, even though the total reported revenue looks weaker. It's a classic move. It's designed to show the market the results of the future business, not the mess of the legacy one.
So that's the cost of simplification, as you call it.
Yeah.
But you mentioned a second item.
Yes, this one impacts the full year view. The full year 2025 EPS figures are also adjusted to exclude the Banamex goodwill impairment charge.
Ah, I remember that.
That was a significant $726 million pre-tax charge they took back in Q3. So when you look at the full year and you exclude both the Russia loss and the Banamex charge, the EPS jumps from $6.99 to $7.97.
So they're just cleaning up years of complicated global M&A mistakes, and the cost of that cleanup is staggering and continuous.
That's the word.
Continuous. Which raises a difficult question. If we focus on that clean 181 figure, the core business looks powerful. But the sheer frequency and the magnitude of these so-called non-recurring charges, Russia, Banamex, the Asian exits, they're constantly dealing with separation costs. $40 million in operating expenses just for Mexico this quarter alone. Is the cost of simplification ever going to stabilize? Or is this drag just the new normal for Citi?
That is the core skepticism we have to apply. They're executing their transformation, but the financial statements remain perpetually noisy, messy.
Right.
It requires the kind of work we're doing right now for an investor to even begin to trust the underlying performance. Until those charges stop, Citi is an execution story, not a growth story.
Okay, let's pivot. Let's go to Bank of America.
Mm.
If Citi's report is defined by all this structural noise, how does BOFE, sort of the standard bearer for predictable banking, stack up? They reported 98 cents EPS, up 18% year over year.
Yeah.
Did they have to script out a Russian bank sale?
No. BAC's result is remarkably cleaner, and this is why their stock often commands a premium. They had the usual smaller adjustments, but, a change in accounting methods for some tax stuff, but nothing that fundamentally distorts the operational narrative like Citi's massive divestiture.
So it's more straightforward?
Much more. BAC is showing organic, straightforward growth. Revenue net of interest expense up a strong 7% year over year to $28.4 billion.
And then there's Wells Fargo, the cleanup story. They reported $1.62 per share. But even they had their own notable item.
They did, but it was a more traditional internal one. Wells Fargo's complexity was, self-inflicted, but focused on internal restructuring.
So what was the adjustment?
The reported 162 jumped to 176 when you exclude their notable item. And that item was a pretty significant $612 million severance expense.
So job cuts, restructuring. It's pain, but unlike Citi, it's inward-facing pain.
Exactly. Wells Fargo categorized this as part of broader, aggressive efficiency initiatives. They're attempting a structural overhaul.
Right.
The CEO touted 5 years of gross expense reductions, totaling $15 billion. This is fundamentally different from Citi's pain. Citi is paying to get out of markets. Wells Fargo is paying to ruthlessly remove headcount and internal complexity, especially now that the Fed's asset cap is gone.
So it's a deliberate investment in a permanently lower expense run rate.
That's the idea.
Okay, so that sets the perfect stage. We have Citi with pain from strategic exits, Wells Fargo with pain from internal cleanup, and BOFA largely just business as usual. Now let's look at the quality of their core revenue engine, net interest income.
Right, the NII. It's the lifeblood of a commercial bank, the purest measure of core lending health.
Simply put, it's what they make on loans versus what they pay out on deposits.
Exactly. In this rate environment, NII is everything.
So who's capitalizing best and who's getting squeezed by the competition for deposits?
Bank of America stands out as the clear leader here. Just high-quality, predictable growth. Their Q4 NII came in at $15.8 billion.
And they reported on an FTE basis, too, right?
Do a fully taxable equivalent basis, which pushes the figure up to $15.9 billion. But the key is the trend.
Okay. You pointed out it was up $1.4 billion, or 10%, year over year, and up $500 million, or 3%, just from last quarter.
Yeah.
How critical is that quarter-over-quarter stability right now?
It is the most critical metric for NII quality. It signals sustained yield expansion. It confirms BOFA is converting higher rates into higher earnings without having to massively raise what they pay on deposits.
So their franchise is sticky.
Very sticky. Their strategy of deepening client relationships is working. Their consumer banking NII was solid. Global Wealth added another $1.8 billion. It's just a robust, diversified engine.
Okay, now to Wells Fargo, the cleanup story. They posted $12.3 billion in NII, up 4% year over year. Is that good enough, given the turnaround narrative?
It's respectable. It's not exceptional. The 4% growth shows progress, and they did it despite headwinds.
Like the deposit mix shift.
Exactly.
Yeah.
Customers moving money from savings to higher yield stuff, that pressures margins. So the fact that they grew NII at all, driven by higher loan balances and repricing, suggests they're managing it well. But you might expect a little more leverage from that massive expense cleanup.
Mm-hmm. And Citigroup.
Yeah.
If BOFA is robust and Wells is consistent, Citi's story, as always, is
Segmented and volatile.
right. What did their NII breakdown look like?
So Citi's reported NII for the entire bank was up 14% year over year, which it looks fantastic on the surface.
Yeah.
But when you dissect where that growth is coming from, it just highlights their fundamental weakness in traditional consumer banking and their heavy reliance on their institutional segments.
Okay, give us the specifics on the institutional side.
The services segment, that's their huge Treasury and Trade Solutions business, saw NII rocket up 18% year over year to $4 billion. And even more dramatically, the markets segment, NII, which is super volatile, driven by trading, that soared 53% year over year.
So Citi is making serious money on institutional scale and market volatility. High margin, but very sensitive segments.
Exactly. Now compare that to their U.S. personal banking segment, their consumer arm. NII growth there is only 3%.
And that's the segment with all the credit risk we're about to talk about.
The highest credit risk, yes. So while the headline 14% NII growth looks aggressive, it's heavily weighted toward institutional and volatile trading revenues. It makes their revenue quality much less reliable quarter to quarter than BOFA's.
And management seems to know this too.
They do. They gave forward guidance for 2026 NII, excluding markets, to grow 5 to 6%.
The emphasis on excluding markets is crucial.
It is. It signals that the huge growth they just saw is unsustainable. They're trying to reset expectations to a more modest core growth rate.
So the takeaway on NII is clear. BOFA is robust and predictable. Wells Fargo, respectable growth. And Citi's strength is concentrated in volatile segments.
That's it.
Which brings us perfectly into part 2, the bad. Because NII is only half the story. The other half is what you have to set aside for loans that go sour.
And who is most afraid of the coming economic cycle? When we assess credit risk, we look at the provision for credit losses, or PCL.
Correct.
The PCL is an expense that reflects management's expectation of future bad loans, the allowance build, plus the current net charge-offs. A high PCL means management is getting nervous.
Let's start with Bank of America again. Their revenue looks stable. Does their risk profile match that?
It does. BOFA's PCL was flat and contained at $1.3 billion for the quarter.
That's flat quarter over quarter and actually down from a year ago.
Right. And their net charge-offs were also slightly lower. It sounds like they are not particularly afraid of an imminent recession.
The signal is tight risk management.
It's a very clear signal. And while consumer charge-offs were up a little bit, Bank of America highlighted a crucial detail. The credit card charge-off rate actually improved slightly.
Wait, it improved? In this environment, that's counterintuitive.
It is. It went from 3.46% last quarter down to 3.40%. That improvement, in the part of the book that usually gets hit first by consumer stress, suggests genuine underlying stability.
Okay. And on the commercial side?
Non-performing loans were up a bit, but they mitigated that by noting that their commercial reservable criticized utilized exposure actually decreased by $1.6 billion. So they're managing it very effectively.
Okay, now to Wells Fargo, the bank that's supposed to be shedding risk.
And they are. They're showing a declining risk profile overall, which is a major positive sign for their turnaround story. Their Q4 PCL was just over $1 billion, down 5% year over year.
NCOs were down even more.
Down 13%, so good signs. But with Wells Fargo, there's always a hidden risk, isn't there? Especially in commercial lending.
Right. The commercial real estate market is under so much pressure. Where is the specific pain point for them?
It is highly specific, and it's the ghost haunting every large commercial lender right now, CRE.
Commercial real estate.
Right. Wells Fargo reported that their commercial charge-off rate is up 0.22% versus 0.18% last quarter. And the source material explicitly links this increase to higher commercial real estate NCOs, predominantly in the office portfolio.
The office portfolio, that's the segment facing the most acute pain globally.
It is. So while their overall allowance was actually helped by a lower provision for CRE, in aggregate, meaning they feel good about their other properties, the stress is concentrated right there in office.
And that trend is not likely to go away quickly.
No. That single high-profile pressure point is a big contrast to BOFA's more diffuse controllable risk.
Now to Citigroup. Their PCL number at $2.2 billion is the highest of the three. What does that tell us about the markets they've chosen to play in?
It tells the story of high-risk consumer headwinds. And that's a structural feature of their U.S. consumer strategy. It's not a bug. Their net credit losses were high at $2.19 billion, pretty much flat.
But the real sobering insight is the guidance they give for future losses.
Yes. In their U.S. personal banking segment, this is where the high risk is formalized, and it's critical for investors to grasp.
What were the numbers?
They gave very specific 2026 net credit loss guidance ranges. For their branded cards, they expect a loss rate between 3.5% and 4%.
Which is high, but maybe manageable.
Right. But for retail services, that's their white label credit card portfolio, the ones with retailers, the guidance range is much higher.
How much higher?
5.75% to 6.25%.
Wow, 6.25%. I mean, that's a number you usually associate with near-prime or even subprime lenders.
That's the essential insight. Citi's U.S. consumer business operates with an inherently much higher expected loss ratio than what you see at BOFA or even Wells Fargo. They are chasing growth in a much higher risk bracket.
So to sum up the risk, BOFA is stable. Wells Fargo has a specific CRE office problem. And Citi is just living with persistently high expected losses in its core U.S. consumer business.
That's it.
Okay, beyond credit risk, we have to look at the expense line. Management loves to talk about efficiency, but sometimes those efficiency drives cost a fortune.
The paradox of spending money to save money. Let's start with Wells Fargo and those continuous severance costs. Their Q4 non-interest expense was $13.7 billion, down 1%, which is good.
But inside that,
They logged $612 million in severance expense, and that was after $647 million in the same quarter of 2024. That's over $1.2 billion in severance in just 2 quarters.
that is the visible cost of their transformation. And the management spin is all about justifying this spending.
Precisely. CEO Charlie Scharf championed this by saying that 5 years of gross expense reductions totaled $15 billion. The narrative is that they're willing to take these huge, visible severance hits now to permanently lower their expense run rate later. It's the price of redemption.
Right. Bank of America, meanwhile, saw their expenses rise to $17.4 billion, up 4%. What drove that? They aren't in a cleanup mode.
No, they're operating normally. BofA attributed the rise to pretty standard stuff. Higher revenue-related incentives, investments in people and tech. But the key detail is that the increase from last quarter was driven primarily by technology investments and, critically, higher litigation costs.
Litigation costs. The operational drain for any large bank, it's the quiet killer on the expense sheet. Unpredictable, never gives a strategic return.
It's the unavoidable tax of being too big to fail. And while that was partially offset by a lower FDIC assessment, the combination of high-tech investment and higher litigation costs ensures BofA's expense line keeps growing even when their revenue is stellar.
And finally, Citi. Operating expenses up 6%. And while the big charges get stripped out, the transformation costs themselves, they're still there.
Absolutely. The divestiture noise dominates, but the cost of the internal transformation agenda is baked right into their standard operating expenses. They explicitly disclosed $40 million in Q4 just for separation costs in Mexico.
Just to get out of Mexico.
Right. Citi is spending heavily just to reach a baseline operational and regulatory state that its peers, especially BofA, already operate in.
So BofA is paying for tech and litigation. Wells is paying to restructure its workforce. And Citi is paying these endless she's to get out of markets.
That's a great summary.
And that clearly impacts their ability to make intelligent small bets on future growth. So let's turn there now to part 3.
Right. Non-interest income, or NIR. This measures fee generation, trading revenues, investment banking strength. It's critical for diversification, especially when NII eventually peaks.
Which it will.
Inevitably. Banks with strong fee income are better hedged against interest rate cycles.
And Bank of America demonstrated phenomenal strength here, especially in wealth management. This is the definition of high-quality, sticky revenue.
It truly is. BAC's NIR in Q4 was $12.6 billion, up a solid 4%, and the key driver was their global wealth and investment management segment. Revenue there grew 10%.
Fueled by what?
Overwhelmingly fueled by higher asset management fees. They were up 13% to $4.1 billion.
Okay, that 13% jump is huge. It means they're not relying on volatile trading fees. They're building relationship-driven revenue that just scales with the market.
Exactly. It reflects rising market valuations and strong new client flows. We're talking $20 billion in new AUM in Q4 alone.
Wow.
And $82 billion since this time last year. On top of that, their investment banking fees secured them a number 3 ranking for the full year. It's strong, diversified, and high quality.
Wells Fargo is also showing signs of fee acceleration, probably fueled by getting that asset cap removed.
Definitely. WFC's NIR grew 5% to $9 billion. The drivers were broad and encouraging: higher asset-based fees, higher card fees, mortgage banking fees. Their big strategic win, though, was in investment banking fees, up 14% year over year.
And their competitive positioning improved dramatically, the M&A ranking.
It jumped from 12th place to 8th. That's a huge signal that management is prioritizing high-margin fee revenue and leveraging their newly regained market perception. They're actively taking back wallet share on Wall Street.
Now, Citi. We know the headline NIR number is going to be terrible because of all the cleanup costs.
Terrible is an understatement. Citi's reported NIR decreased a staggering 27%. That is, that massive Russia loss again, booked in legacy franchises, just completely obscuring the core performance.
So we have to look past that reported number and find the underlying strength.
And it's there. If we focus on their strong segments, banking NIR was up, with investment banking fees up 35%. Services fee revenue was up 9%.
So, strong fee growth in banking and services, just like their NII strength, but the overall number is just perpetually ruined by the divestitures.
It's a tale of two different banks operating under the same, very noisy roof.
Okay, so let's look past the numbers and at the strategy. We have to assess the tangible commitments they're making to technology and their market position. Who is making intelligent long-term bets?
Let's start with Citi, the self-proclaimed transformation specialist. As we've discussed, their innovation focus is entirely defensive and internal. This is not about winning new clients yet.
Yeah.
It's about stabilizing the house.
So what does defensive innovation look like on the ground?
It means focusing on regulatory remediation, simplifying operations, and reducing their exposure to massive potential fines. Their key metrics show this. Over 80% of their transformation programs are at or near their target state, and crucially, they retired or replaced 548 applications during 2025.
548 applications. That sounds like a massive, grueling technological cleanout. What does that actually achieve for an investor?
It fundamentally reduces the risk of massive consent order fines from regulators. Every one of those legacy applications is a point of failure, a security risk, a compliance risk. By retiring them, they're collapsing silos and making their regulatory reporting faster and more accurate. Their AI and tech use reflects this. They're using AI for regulatory reports, automating controls. They say AI-powered tools generated 100,000 hours of capacity weekly through automated code reviews.
So the verdict on Citi's innovation is that it's necessary, but it's defensive. They're just trying to get to a baseline before they can even think about making external revenue-generating bets.
Now for Wells Fargo, they are in aggressive comeback mode. Their focus is offense, market share recovery, and driving a higher return.
And they set an extremely bold target to signal that.
They set an aggressive new medium-term return on tangible common equity, or ROTCE, target of 17 to 18%.
Up from the 15% they just hit. That screams ambition.
It does, and they have the capital to back it up. They returned $23 billion to shareholders last year, and the growth momentum is evident. Credit card new accounts grew over 20%.
Wow.
Auto lending is back to growth. Their tech focus is on modernizing their core platforms. WFC is clearly taking its massive cost savings and reinvesting it for market penetration. They're playing aggressive catch-up.
Finally, Bank of America. Their strategy seems less about a big pivot and more about flawless execution of an already established digital playbook. The digital juggernaut.
That's the most accurate description. BOFA's focus is on digital ubiquity and deepening relationships. They don't need a pivot. They just need to keep executing.
And the numbers are staggering.
38.4 million consumer checking accounts, 4.3 billion digital logins. 69% of their total sales were digitally enabled. This is their competitive moat.
And their AI integration, unlike Citi's, is clearly client and commercial facing. It's designed to make money.
Precisely. We see their digital assistant Erica supporting interactions in their crucial CashPro chat.
Which is their B2B payment platform.
Right. Used by huge corporations. Those app payments were up 18% to $336 billion. This shows digital adoption translating directly into high-value client assets and payment volume.
So we have three distinct strategies. Citi is defensive and internal. Wells Fargo is aggressive and external. And BAC is just deepening relationships through seamless execution.
And that leads us right to the final synthesis.
On part 4, our final verdict and the iron ranking.
Let's bring it all together. NII quality, risk, capital strength, and the operational pain each bank is enduring.
For core revenue, BOFA had the most consistent, high-quality NII at plus 10%. Citi was highest at plus 14, but highly volatile. Wells was respectable at plus 4.
On provision for credit losses, BOFA is in tight control at $1.3 billion. Wells Fargo is also controlled, but with that specific concentrated risk in the CRE office portfolio. And Citi carried the highest PCL at $2.2 billion, with those extremely high consumer loss expectations.
And the pain points. BOFA, litigation, and tech investment. Wells Fargo, that big severance expense and CRE pressure. And the Citi is just buried under a perpetual stream of unpredictable noise. The Russia loss, the Banamex charge.
We have to consider capital. We look at the CET1 ratio, Common Equity Tier 1. It's the core measure of safety and liquidity.
Okay.
Citi holds a high CET1 ratio of 13.2%. Wells Fargo, despite the cleanup, has a tighter ratio of 10.6%.
Why is that difference so stark? Why does Citi have to hold so much more capital than Wells?
Because regulators are essentially forcing Citi to hold more capital as a safety net against their massive operational and complexity risks. The very transformation they're undergoing. Regulators demand a higher cushion when the underlying structure is complex and prone to these huge unexpected charges. Conversely, Wells is running tighter, signaling management confidence and regulatory agreement that the cleanup is mostly done and they can aggressively return capital.
That's a huge distinction in how investors should perceive the risk. So, it's time for the iron ranking.
We begin with the safe play, Bank of America.
Why is BAC the safest choice in this field?
They just offer the best quality P&L statement among the three. Their NII expansion is consistent and broad. Their fee income is superior, derived from sticky sources like wealth management. Their credit metrics are the most stable, and their strategy of digital integration translates directly into high-value client metrics.
And no massive restructuring pain.
The notable absence of it. It makes their future outlook highly predictable and defensive. They're just executing flawlessly on an established playbook. They are the default choice for stability and quality.
Okay. Next, the high momentum player with substantial risks. The value trap. Wells Fargo.
Wells Fargo's results were, superficially strong. They have high momentum, boosted by the asset cap removal and that aggressive new ROTCE target. They look cheap relative to peers, having endured years of massive cleanup costs. The redemption narrative is compelling.
But where is the trap hiding?
The trap lies in the persistent execution risk and that specific identifiable asset risk. The internal restructuring is clearly not finished. But more importantly, the looming threat from commercial real estate office loan losses means the cleanup isn't entirely internal. It's dependent on the CRE market not collapsing.
So they're highly dependent on flawless execution.
Flawless. And their tighter CET1 ratio suggests less room for error if the economy sours.
And finally, the bank that investors are forced to be perpetually patient with. The BAG. Citigroup.
Citigroup is undeniably a complexity story. It's defined by timing risk. While the core institutional businesses are performing exceptionally well, the results are perpetually obscured by these massive, unpredictable charges.
Right.
The company is spending heavily and defensively on internal transformation and remediation. That's an essential process, but it does not translate into immediate shareholder value.
They're paying for technology to fix past problems, not to generate future revenue. That's a huge shareholder drag.
Exactly. For the next, say, 18-24 months, Citi remains an operational cleanup story with high expected consumer credit losses. Investors are holding the bag on continued complexity, regulatory risk, and noise until this multi-year transformation is truly complete. Buying Citi is betting on the eventual success of a complex, long-term operational fix, not on current organic growth.
So remember this as you watch the market react to earnings headlines. Glossy EPS numbers are misleading. You have to look at the quality of the core NII and the risk provisioning to understand the truth.
And if you want a final provocative thought to mull over, consider the sheer divergence in their tech spend. We noted that Bank of America is hyper-focused on external, client-facing AI to drive revenue growth. Think Erica and CashPro. Citigroup, on the other hand, is entirely focused on internal, compliance-driven AI to reduce regulatory fines and manage complexity, retiring 548 applications.
So in a world of increasing regulatory complexity and rising tech costs, which strategy client revenue generation like BOFA or compliance cost reduction like Citi will deliver the superior return on tangible common equity over the next 3 years? Which approach is the more resilient mode?
That question of internal stability versus external growth defines the fundamental choice facing investors in large-cap banking today. Only time and future deep dives into their balance sheets will tell.
Thank you for joining us on The Deep Dive. We'll see you next time.